Millionaires understand that wealth accumulation begins with smart investments. Wealth isn't built on just one paycheck. Multiple income streams equals maximum freedom. Millionaires know the hard truth. Here are some of the most common investments that play central roles in high net worth profiles.
This one is a juicy today. We're going to break down the video made by Karlton Dennis. And we're going to do this through the lens of wealth management, something no one online seems to do anymore. Everyone is just trying to sell you something, convince you that one thing is better than the other thing. Well, I don't have anything to sell it to you today, but I do have a message, which I believe for anyone who's trying to build wealth, they should definitely hear it. All right, without further ado, let's get to it.
Millionaires understand that wealth accumulation begins with smart investments. They don't simply earn money, they deploy it strategically into assets that can grow, produce income, and preserve value over time. Investments are carefully diversified across multiple asset classes to balance risk, growth, and cash flow. Here are some of the most common investments that play central roles in high net worth profiles.
Okay, no. Wealth accumulation and growth actually starts with active income, aka your job or a business. For most of us, it starts with the job. And I say that all the time, guys. You cannot save your way into a Lambo. Not happening. You putting together pennies ain't gonna grow you any wealth. If you are making $50K a year, you can reuse as many tea bags as possible and invest the savings, and it won't build you any wealth. Nothing matters until you start making good salary. As a bottom 50% of a tax filer, you're already paying around 4% in taxes. There's nothing to cut here, okay? No deductions matter to you. There's no meat on the bone. Even IRS says, fuck it. They do not even audit poor people because there's nothing to audit there, okay? Taxes are not the problem for you. And guess what? Expenses ain't a problem for you either because you have nothing to spend anyways. You cutting your lattes ain't gonna build you an asset base. So stop washing all your Ziploc bags as if they were dishes, okay? You make $50K a year. Enjoy your Starbase and spend all your time thinking about how can you increase your earnings. Your only concern at this level of wealth is income. This is it. Cut the noise. The wealth journey starts with active income, and then you pass the baton to the passive income sources, which we will discuss and touch on later in this video.
Rental real estate. Real estate has always been one of the main ways that millionaires build wealth. Many own rental properties or commercial spaces that grow in value over time while producing steady income. Unlike most investments, real estate is tangible and it can be leveraged, meaning investors can control more assets with less of their own money.
Okay, that's right. Real estate is definitely one of the best investments due to multiple reasons, but leverage is definitely one of the key reasons why. I call it double dipping. And the reason I call it double dipping is because you get to tap into other people's wallets, other people's pockets, right? You get to use the resources that are not yours. And it's fun, it's exciting, but it's also risky, okay? And that is another beauty of real estate, that it tends to be stable compared to other asset classes. And therefore, the risk of leverage is not nearly as dangerous as using leverage in the stock market. And we all know how these stories end, right? Okay, now double dipping is so powerful, not only because it allows you to amplify your returns, but also in the real estate world, it comes with tax advantages. Interest is tax deductible, which effectively lowers your cost of borrowing.
Real estate offers incredible tax benefits, like being able to deduct depreciation or even using a 1031 exchange, which lets you delay paying taxes when you reinvest profits. Over time, this creates a strong, reliable source of income and long-term growth.
And here is the main reason people love real estate. This is the magical word that gets people excited more than even hearing your girlfriend saying, you were right. Even more than that. I can't imagine that being the case, but it is. And yeah, I'm talking about depreciation. Depreciation is what turns your real estate from Corvette to a Lambo. And for those who do not know what depreciation is a phantom expense, meaning that it doesn't exist. It's like a fugazi.
It's all a fugazi. You know what a fugazi is?
No, fugazi. It's fake.
Yeah, fugazi. It's a wazi, it's a woozy, it's a fairy dust. It doesn't exist. It's never landed. It is no matter. It's not on the elemental chart. It's not fucking real.
Right? So the reason it is so appealing is because this is how the government incentivizes housing. This is the number that decreases your taxable income. So, for example, let's say you own a rental property and you make $30K from your property, and after all expenses and taxes, you net only $2,000. So you're not happy because it's too much work for too little reward. But the government says we want our landlords to be happy, so why don't we try to lower their taxes? Now, you just made $30K. If that was your job, you would pay tax on the full amount, a full $30,000. But because it's real estate, the government said, wait a minute, you have all these expenses such as mortgage interest, insurance, property taxes, commissions you paid, maintenance and repair costs. So why don't you deduct those, right? And the landlords were like, okay, that is just not enough. It's nice, but it's not enough. So the government said, okay, why don't we make up a cost that is not really a cost, but we'll kind of call it a cost. How about that, huh? How about that? And obviously the landlords were like, fuck yeah, that is great. So now real estate has this phantom expense that you can deduct for tax purposes, and that allows real estate investors to pay very minimum in taxes. In many cases, depreciation can literally take your paper income all the way to zero. In which case you would report to the IRS that you made no money, but you actually did make money, right? And it's like you say to the government, I didn't make any money this year. And the government says, oh, yeah, this was a tough year for you, poor fella. Well, I hope you'll do better next year. Here's a tax break. But next year, you don't do better because of that depreciation. If it reduces your taxable income below zero, meaning it's negative, you can claim a loss and carry that loss forward to the next year. So basically, you can report making no money for decades while simultaneously being a billionaire, like Trump. Well, actually, exactly like Trump. Okay, and then he mentions 1031 exchange as a way to buy a property without having to sell your existing property, right? So you do it by exchanging it. So if I had a Ferrari and you had a Lambo and you wanted to have a Ferrari and I wanted to have a Lambo, instead of me saying, hey, go sell your Lambo and then buy my Ferrari, we can just swap it, right? So, and if it's done properly, the government says, oh, nothing happened here, nothing to see here, just two people, swapping their stuff, good old barter, right? So the reason it's so powerful because this is how you protect your gains, aka all the appreciation that happened in your house from the taxation. Remember, if you never sell, there's nothing to tax. So this swap doesn't trigger the tax event. And in the wealth management world, we say, think outside the sale.
Index funds. Even the wealthiest individuals often allocate a substantial portion of their portfolio to broad market index funds. These funds offer steady, long-term growth, low management fees, and a natural diversification that spread risks across many companies and sectors. Millionaires tend to invest consistently and patiently, focusing on long-term gains rather than trying to time the market.
Okay, so index funds is probably the most boring missionary style of investing in the whole universe. But guess what? How many of you thirsty animals bone each other in that position, huh? All of you. Same thing here. It may sound boring, but it's practical. And Karlton is totally right that this is one of the biggest wealth builders out there. And it enables this, and it's also like passive in nature, which enables people to focus their time, attention, and energy into more active sources of income while simultaneously enjoying the average 10% return that it offers. And by the way, markets are so wild. We often talk about 8 to 10%, but listen, if you look at the last 15 years worth of data, the total return was around 15%. How about that, huh? For those who do not know, the total return includes dividends and price appreciation. Not saying it's guaranteed, but let's be clear, this outperformed many asset classes, including real estate, while being a strategy that is like sit and forget type of strategy with embedded diversification benefits for most people. And diversification, as I always say, diversification drives participation. Why? Because if you had to pick a stock, you need a skill. You do not need a skill to participate in the stock market the way you need a skill to build like real estate or businesses. Okay, so that is what makes it attractive. It's like losing weight without going to the gym. It's very appealing. Now, it's important to mention that investing in index funds also has tax benefits compared to W-2 income. Long-term capital gain tax rates are typically way more beneficial than ordinary income tax rates. And dividends are also taxed at the lower rate. Now, if you are smart, you would also utilize investment accounts that offer preferential tax treatment like retirement accounts. So I hope that you start seeing that rich people just play the game. They don't really necessarily break the rules, but they understand the rules and they try to use them to their advantage. You know, I used to work in the construction industry in Lithuania, and I don't smoke, and I didn't smoke back then, but everyone else did. Now, first, I didn't realize it, but I was not allowed to take breaks unless I needed to go to the bathroom, drink some water, or it was a lunch break. However, smoking was so prevalent that no one really cared if you took a break to get a smoke. So smoking was a way to kind of like game a system. So some of these bums would work 15 minutes and take 10-minute break to smoke while I was like breaking my back, trying to work hard, impress everyone. I was working so hard to exhaustion almost. And eventually, obviously, I quit because I was like, fuck this shit, right? It's too hard. It's really annoying. I'm the only one working here. So it's all about understanding the game. Anyway, I hope you start seeing the pattern here. Rich people do not just fall in love with real estate, index investing, or anything else. They just observe. They look into the field. They see the index funds offer a nice, consistent way to build wealth over time with minimal active participation. They understand that the government also gives them tax breaks, so they use it. And why wouldn't they, right? Like, it only makes sense.
Next is gold and precious metals. Gold and other precious metals often appear in millionaire portfolios as a hedge against economic uncertainty and inflation. While these assets do not generate income, they preserve value and reduce overall portfolio risk. Wealthy investors view gold not only as a short-term profit tool, but as a stabilizing element in a diversified investment strategy. Including metals in a portfolio provide a layer of security during periods of market volatility, currency fluctuations, or geopolitical tension. So by holding precious metals alongside other assets, millionaires maintain balance between growth-oriented investments and wealth-preserving strategies.
Again, gold, silver, copper, and other metals. Notice how he emphasized preservation and hedging as the two main reasons for holding these assets. Rich people do not sit there all day long watching the gold charts and speculating on the price movement. Hedging and preservation. Metal investing tends to become very popular under certain circumstances. Now, these circumstances happen fast and very unexpectedly. So because it is so hard to forecast these events, you just hold the precious metals. And once the stressful times come around, you have protection, because more likely than not, your traditional asset classes like stocks probably will get hit. So you want to have some wealth that is actually increasing in value while your stocks may be going down. That is called a hedge. But because the purpose of holding these precious metals is hedging and not speculation, you want these assets that tend to be stable and just grow very slowly over time. And this feature is called value preservation. There are no significant tax benefits here, but again, the main purpose of investing in these metals is hedging and capital preservation. And the people who actually understand this concept the best are women. They find a simp, friend zone the poor guy, and then go fuck everyone else and then share the stories with the poor guy. Now, the dude thinks that he's being slick by pretending to be her friend, but the little bouncy booty here, she's exploring her options while fully knowing that she can get with that friend anytime she wants. That is a classical preservation of asset. And then years later, say, oh, I was so blind, I didn't notice that you're such a great guy, that you're my soulmate and you were here all along. Now keep in mind, she only supposedly noticed and discovered her soulmate after she is alone and no one wants her anymore. And this is a classic hedging scenario.
Next is Bitcoin and digital assets. In recent years, digital assets such as Bitcoin have also emerged as a component of many high net worth portfolios. These assets are highly volatile, yet they offer asymmetric growth potential that can complement traditional investments. Many wealthy investors see them as a hedge against inflation and a way to access new, fast-growing markets.
Now here he talks about Bitcoin and crypto in general. Remember, every asset brings something to the overall portfolio, right? Real estate brings leverage, tax benefits, right? Stocks bring passive growth. Insurance can bring tax advantageous growth with a downside protection. Bonds bring stability and income. So when he talks about crypto, this brings exponential growth potential. Now it's risky. You as an individual, you cannot control it or influence it. Therefore, rich people typically invest a small portion of their overall portfolio into it. If it goes up, it could generate a significant value, but if it goes down, you only lose like 1 to 2% of your total assets. And it's similar to how regular people view lottery. They're not going to get hurt if they spend a few dollars, but the winnings could be substantial. So that is exactly the role it plays for majority of the wealthy people. Now, I get people talk about technology and crypto being the future and blah, 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 and it may or may not be true, but that is not why wealthy people invest in it. The point here is that from a wealth management perspective, you want to have exposure to the asset so you can experience all the potential, but you don't want to position yourself in a way that you can get hurt.
Wealth isn't built on just one paycheck. Millionaires know the hard truth. Relying on a single job will never make you rich. They don't just work for money, they make money work for them. Side hustles, businesses, investments, they juggle them all. Each new income stream is a safety net, a growth engine, and a way to take control of their financial destiny. And so as a result, many millionaires start, buy, or scale businesses that can generate multiple revenue streams at once. Sales, subscriptions, royalties, licensing, every avenue adds fuel to the fire of wealth. Side gigs, consulting, or freelance work amplifies their earnings even further, giving them freedom while their money continues to grow. Multiple income streams equals maximum freedom. Most millionaires maintain 5, 6, or even 7 streams or more, from jobs, real estate, and dividends to business profits and crypto. Each stream doesn't just add money, it adds stability, opportunity, and power. So by diversifying, millionaires stay untouchable during market swings. They also reinvest strategically and keep their financial momentum unstoppable.
Now, this section is really, really important to understand. Multiple streams of income. Listen that he didn't say multiple businesses. Multiple streams of income. This is the key. And the way you do it is by deploying capital, aka investing. Your active income should always go into building assets that can generate alternative income for you. Many people make active income, pay bills, and invest the rest. Wrong. Earn income, make money, invest, and then spend the rest. If you have gotten a raise, that doesn't mean buying a better car. Put more money into your 401k, put more money into building assets that can generate you income. The goal in life is to accumulate assets. Assets equal wealth. You're not rich until your assets are generating you money to live off of. Until your passive income doesn't exceed your active income, you ain't rich. You may be a well-paid slave, but you're definitely not rich.
Next is tax strategy. With strategic tax planning as a critical element of wealth building, millionaires are aware that it's not just about how much you earn, but it's about how much you keep. High net worth investors structure their investments, their businesses, and financial decisions with a focus on minimizing tax liability while maximizing after-tax returns.
Next, he talks about taxes. Now, this is irrelevant for most of you because the bottom 50% pays a very negligible amount in tax. According to some numbers, the bottom 50% of tax filers pay roughly around 4% in tax. So listen, do not tell me that you need to get into the real estate game because you're trying to get those depreciation tax benefits if you make $50,000 a year, okay? First, look at your income, active income. Then think how to increase it. Then think about how to build multiple streams of income, and only then start thinking about taxes. And if you listen to him carefully, he emphasized that the rich focus on keeping assets first because they already made it. They are in the preservation and asset growth mode because they have something to preserve and grow. You ain't got nothing to preserve, my friends, so keep building, keep working. Overall, I like this video, okay? It's short, it's to the point. Now, many of you may not be familiar with many of these concepts because you're not in the stage in life where some of these concepts are relevant for you. But the key here is to understand the process of building wealth, right? So you start with your active income first, okay? And in most cases, it's gonna be a job. Then either start a side hustle, build your own business, or focus on going up the career ladder. All of these are ways for you to increase your earnings. Now, once you make enough money to the point where you're comfortably cover all your necessities and obligations, now you can start looking into building multiple sources of income. And as we saw in the video, rich people do not depend on one source of income, and especially they do not rely on a salary income. This is because salary is the most inefficient way to make money. However, this is the one we typically start with. Another thing to note here that we always say rich people do this, rich people do that, but we do not really mean that they themselves go and do that. Most of that work is done by third-party advisors, tax strategists, attorneys, consultants. So do not think that you can have a job, trade commodities, and do your own tax strategy. That is why sequencing matters. Once you have income, now you can use that money to make more money and hire someone who can help you navigate these waters that you have limited expertise in. All right, if you liked the video, please like and subscribe as always. If you didn't like the video, then please leave the comment down below to let me know what I can improve on.